Hello and welcome to our 2 days educational session on IFRS 18 presentation and disclosures in financial statement, the new standard that was formerly known under the project name primary financial statements. The IASB, EFRAG and Business Europe welcome you to this educational session, which was designed to provide insights, especially to corporates on their journey to implement IFRS 18 and support EFRAG in their work to provide endorsement advice to the European Commission. My name is Michael Fechner, member of the EFRAG Financial Reporting Board and the Business Europe Accounting Sounding Board with a day job at Mercedes-Benz. And I have the honor and the pleasure to serve you as a moderator today and lead you through this morning. Today's agenda, apologies, maybe first a disclaimer. We will mention that everything that is said today is an expression of personal views and is not necessarily the views that will finally be taken by any of the presenters' bodies or EFRAG in their endorsement advice. Today's session is structured following 4 topics. After a brief introduction, which I will continue with in a minute, we will see presentations on 4 topics, being categories and subtotals, management-defined performance measures, grouping, aggregation and disaggregation of information, and limited changes to the cash flow statement, effective date, and transition requirements. Each of the topics will be introduced by the IASB, and afterwards we will have a sharing of experience by our distinguished panelists. And of course, you may ask questions along the way. Before I go down and introduce the set of distinguished speakers that we do have today, let me remind you of 2 things. First is, as you know, IFRS 18 has been finalized and published by the IASB. That is why we will focus on the implementation of the standard today and not so much on the design, purpose, or cost-benefit aspects of it. So you may bear that in mind when posting your questions, which leads me to the second item, question. You will find along the slides a QR code, which will guide you to the Slido space. Thank you very much. That's it, where you can log on, post your questions, and that's why you should keep logged onto Slido. You can upvote questions posted by other participants, and we will then address the questions with the most votes with the highest priority. So before I go on to introduce now our set of distinguished speakers today, let me give a big thank you to the EFRAG team who have worked hard to put today's session together and did a great job in the organization. So moving on to our panel, thank you very much. Start with the EFRAG side, we have Katrin Schöne. She is the project director at EFRAG and works at a variety of projects. I know that very well. And she will lead us also through the endorsement process of EFRAG in just a minute. We'll go over to the IASB, and we are honored to welcome Bertrand Perrine, IASB board member, and since 2021, if I'm not mistaken, yes. And he's also a former preparer, so best suited for this corporate event. He's joined by his colleagues Nick Barlow from the IASB technical staff, who worked on the primary financial statements project already since 2018. He's also joined by Rowan Hasegawa from the technical staff, who's actually a seconded partner from KPMG Japan, and she is the project lead for primary financial statements. Last but certainly not least, we have Juliane Upmeyer, member of the IASB technical staff and a former preparer. And she has also been working on the primary financial statements project for the past 3 years and is now involved in implementing IFRS 18 into the IFRS taxonomy. So to all of the colleagues of the IASB, warm welcome. We're very happy to have you here today. For our panelists, we are excited that you will share your experience also from the field test with us today. We welcome Andreas Gattung from Volkswagen Group, where he is the head of the Accounting Principles Department. We have Eva Maruszewska, professor at the University of Economics in Katowice in Poland, with a vast experience as she has served as a chief accountant and financial director among various entities. Also from Poland, we welcome Maciej Tuszkiewicz, chief accountant and finance manager at Welding Alloys Polska. He's also a researcher and lecturer at the University of Economics in Katowice in Poland, and gives us a bit a flavor of the implementation efforts by smaller companies. Then we have Lars Hammers, joins us from DSM Firmenich, where he works as a technical accounting and reporting expert. And last but certainly not least, we have François Andreoli from Nestlé in Switzerland, where he's in charge of IFRS compliance and business support, and he there heads the implementation project of IFRS 18. To all of you, very warm welcome. We're very looking forward to hearing your thoughts today. So please make sure that you log on to Slido. And with that, that has been the introduction from my side. I will now hand over to Katrin Schöne, who will introduce the endorsement process that EFRAG is undergoing now to us, before we then hand over to Bertrand and his team to lead us into the first topic of categories and subtotals. Katrin, over to you.
Thank you very much, Michael. When the IASB issues a new IFRS accounting standard, then according to the EU law, it has to be endorsed. This came into force with the regulation number 1602 in 2002. And this regulation as well establishes a specific endorsement process where we have two advisory bodies, which one is EFRAG and the other one is the Accounting Regulatory Committee. The European Commission has sent us already an endorsement request. This happened on the 29th of April. It is an endorsement request which includes no additional requests. This is different from what we experienced for IFRS 16 or IFRS 17. So it's good news that we do not have to assess additional criteria beside the ones that are the normal endorsement criteria. EFRAG is planning to work over the next months on the draft endorsement advice. So that means that we will prepare an assessment of the endorsement criteria that we will publish for public consultation. We are planning to do this by the end of the year, and we are planning to submit the final endorsement advice then to the European Commission in Q2 2025. After this, a process at the European Commission level is starting. There are several steps that includes translation of it and the submission to the European Parliament to get advice from the ARC meeting. So this process takes at least 6 months. Overall, we expect then that the endorsement is finalized earliest end of 2025 or beginning of 2026. This would be then published in the official journal, so that the last step is that the endorsement is the endorsement becomes public when the official journal includes it, and we would publish then a news item as well on EFRAG level that you are aware that the endorsement took place. The endorsement criteria that we have to assess during this process are on the next slide. So you can see that we have technical endorsement criteria and criteria for the European public good. So the technical endorsement criteria include relevance, reliability, including prudence, comparability, understandability, true and fair view. The other criteria that we have to assess are the European public good criteria. So the potential effects on the EU economy, cost-benefit analysis, and potential effects on stakeholders. As I said already, we do not have to assess, in this case, additional criteria, which will smooth the process a bit. So we do not start to assess the endorsement criteria from the beginning. We have received already a rich feedback during the consultation process. On the next slide, you can see that we have received feedback during the field testing from the comment letters. We participated in the targeted outreach. The targeted outreach did not only include the items to be addressed by the IASB, it included as well additional criteria. We had technical discussions on EFRAG level, and we consider as well the IASB discussions where they tried to balance the feedback from different stakeholders to mitigate any issues detected. So the task for us is now to connect these feedback to the endorsement criteria. So we have to assess the endorsement criteria step by step, and so we have to connect this feedback overall to each of the different criteria. We have to identify then remaining topics. This event is part of this identification process. So we expect that we get from the questions raised some idea where some challenges might be. As well, we might receive some feedback about which parts are costly. What we do in addition is that we go through the financial statements of several selected entities and try to have an impact assessment. And the assessment of the European endorsement criteria, like that is mainly to assess whether it's good for the European public good, then we will have a public consultation, and we try to get feedback as well how these IFRS 18 might compete with US requirements. So we assess all this, and with that I would like to hand you over to the IASB. And maybe one last thing what I would like to say. During the endorsement phase, we might give you different feedback compared to what we had in the comment letter phase. During the comment letter phase, we try to get the optimal standard. So with this feedback, we try to balance everything and get the optimal standard out, while we have during the endorsement phase to assess whether this standard is good enough to be applied in Europe. So the feedback in the endorsement advice might be a bit different from those that we had in the comment letter. And with that, I hand over now to Bertrand. Thank you very much.
With maybe one quick amendment by my side, so your input is highly valued. One thing that I forgot to mention earlier is that you will find the slides that we showed today on EFRAG's webpage, along with the biographies of all the speakers today. So feel free to get a copy of those. Thank you very much. And now over to you, Bertrand.
Thank you. Thank you to both of you. Good morning, all, and thank you for taking the time to attend today's webinar. I would like first to thank EFRAG and BusinessEurope for organizing today's event. I look forward to hearing my fellow panelists' views and answering participants' questions. The technical staff, the IASB technical staff with me today, Ran, Nick, and Juliana, and myself, we are very pleased to be able to share with you more about the IASB's recently issued accounting standard IFRS 18, which deal with presentation and disclosure in financial statements, also called primary financial statements. For us, IASB, and very likely for the ecosystem, IFRS 18 is a significant milestone in the journey to improve communication in the financial statements. The requirements bring the most significant changes to the statement of profit or loss since the establishment of the IASB and the implementation of IFRS in Europe, and deliver much needed global comparability of companies' financial statements for the benefit of investors. So in this slide called helicopter view, what are those changes? So these changes introduced by IFRS 18 respond directly to investor demands for better information about companies' financial performance. The requirements and supporting guidance that we will discuss today provide companies with better tools for improving how information is communicated in the financial statements. Overall, the package of requirements gives investors a better basis for analyzing and comparing companies' performance. These requirements also reflect the feedback we received from stakeholders throughout the research phase of the project and throughout its development to the exposure draft and the IASB's redeliberation that followed the comment period of the exposure draft. Throughout this process, we received significant engagement from our stakeholders, and I would like and my team also to take this opportunity to thank those European stakeholders who sent us comment letters, participated in fieldwork, and attended outreach meetings. The final standard is certainly a better product thanks to your participation. A warm thank you to all. The next slide presents another helicopter view of the new requirements that more details going forward. So the requirements in IFRS 18 cover 3 key areas, each of which we will discuss in turn. The first set of requirements structures the statement of financial performance, the profit or loss statement, requiring companies to present 2 new defined subtotals. The structure is consistent with how in a statement of profit or loss, so it will provide a consistent and comprehensive starting point for investors' analysis and help investors compare performance between companies, in particular using the operating profit subtotal, which will now be defined and therefore more comparable. The second key set of requirements relate to disclosing information about company-specific measures of performance called management-defined performance measures, and which are required to be disclosed in a single note to the financial statements. These requirements will help companies complement information provided using the new structure in the statement of profit or loss with company-specific information about performance and provide investors with more transparent information about those measures. And the third set of requirements enhances guidance on grouping of information, also known as aggregation and disaggregation of information in the financial statements. This will help ensure investors receive material information, making financial statements more understandable and useful for them. We will also cover some of the other targeted changes made by the IASB to the cash flow statement in conjunction with issuing IFRS 18, and we will touch on the effective date and transition requirements briefly. Today we will be focusing on what is new in IFRS 18, but note that the new standard will replace IS1, which sets out requirements for presentation and disclosures in the financial statements. Many aspects of IS1, for example, those relating to the presentation of the statement of financial position, will be carried over without change. The standard will be effective from 1st January 2027 with an option to apply earlier, and as Catherine reminded us all, subject to the endorsement in the European Union for European Union companies to be able to apply it. I will now turn over to Rohan, if I'm correct, to present the next or the first set of requirements on categories and subtotals. Rohan, over to you.
Great, thank you very much, Bertrand. And the requirements on subtotals and categories, as Bertrand has mentioned, respond to investor feedback that it's difficult to compare financial performance because companies' statement of profit or loss vary in content and structure. So IS1 requires a company to present revenue and profit or loss, but no defined subtotals in between. So varying presentations have developed as a result, and this diversity makes it difficult for investors to analyze companies' financial performance. And in the effects analysis, which we published together with IFRS 18, we looked at a sample of 100 companies reporting under IFRS accounting standards. In the statement of profit or loss, we found similarities in the labels of subtotals presented, but a high degree in diversity of how those subtotals were calculated. So 61 of the companies in our sample reported an operating profit subtotal, but we found at least 9 different ways that those operating profit subtotals had been defined, and the content was quite diverse in what had been included in operating profit. IFRS 18, as a result, introduces 3 new defined categories to provide a consistent structure for the statement of profit or loss. And those categories are operating, investing, and financing, and they align with the way that users typically analyze the financial statements of a company. And it also introduces 2 new required subtotals, which are operating profit and profit before financing and income tax. To help explain the structure, it's helpful, I think, to look at an illustration, which you can see on the right-hand side of this slide. So this slide is illustrating a typical statement of profit or loss for a general corporate applying IFRS 18. I will talk about each of the categories in turn, but just to provide an overview, the operating category is defined as the default category. So operating profit will give a complete picture of a company's operations for the period. The investing category includes income and expenses that investors generally analyze separately to a company's operations. And then the profit before financing and income tax subtotal in the financing category will allow investors to analyze the performance of a company before its financing. There will still be a requirement, as in IS1, to present additional subtotals. In IFRS 18, those additional subtotals are required if they are necessary to provide a useful structured summary of the company's income and expenses. And Juliana will explain more about this term useful structured summary when we get to the later in the session when we talk about grouping of information. But for the purposes of understanding the structure subtotals, it's enough to say that the requirement for additional subtotals is similar to the requirement in IS1 today. And as an example of such a subtotal, you can see gross profit, which is highlighted in grey on the slide. Now, if we move on to the operating category, let's wait for the slide to move along there. The operating category includes all income and expenses that are not classified in the investing, financing, income tax, and discontinued operations category. It's therefore the default category that comprises all income and expenses from a company's operations, including volatile and unusual income and expenses. Defining operating profit in this way works well with different business models and is simpler to apply than a direct definition, which may require significant judgment to apply. And the operating category includes, but is not limited to, the income and expenses from a company's main business activities. And next, the investing category, if we move to the next slide, includes income and expenses from assets that generate a return individually and largely independently of the resources of a company. It also includes incremental expenses directly attributable to the acquisition and disposal of those assets. So, for example, transaction costs and costs to sell. And examples of such assets are rental income and remeasurements of investment properties, interest income and dividends, and fair value changes on financial assets. IFRS 18 also requires companies to classify in the investing category income and expenses from cash and cash equivalents and income and expenses from associates and joint ventures accounted for using the equity method. As classification of income and expenses from investments accounted for using the equity method was a topic the IASB discussed at length and consulted widely on, Bertrand, could I ask you to talk a little bit about why the IASB decided on this classification?
Thank you, Ron. Sure. Yes. I come. This was a topic indeed that received a lot of attention by our stakeholders and therefore by the IASB. Some of these types of investments are quite separate from the operations of an entity and would be the types of income and expenses the investing category was designed to capture. However, there are some associates and joint ventures that are very closely related to a company's operations. Trying to separate the two in a consistent way proved very challenging. When the proposal were first included in the exposure draft, they tried to make this distinction. You remember the integral, non-integral categories that were proposed at the time. However, many stakeholders opposed these proposals, if not most, in part because of the challenges involved. In addition, there was strong feedback from investors that regardless of the relationship, they typically analyze these income and expenses separately from a company's operation, and so strongly supported including the income and expenses outside of operating profit. This does not mean that investors think that the result from associate and joint venture is not important to a company's operations. However, investors explain that they use different methodology to analyze them because firstly, investments accounted for using the equity method do not have any revenue contribution and have a distorting effect on operating profit margins of a company. Secondly, investors want to see an operating profit tied to the financial performance of controlled entities and assets, and companies do not control associates and joint ventures. And thirdly, share of profit or loss of associates and joint ventures accounted for using the equity method is a post-tax and post-financing amount, hence the distortion the investors do not like in the operating profit margins. To help companies to communicate operating performance of associates and joint ventures, IFRS 18 allows a company to present the share of profit or loss from associates and joint ventures accounted for using the equity method immediately after operating profit and to draw a subtotal of operating profit and income and expenses from investments accounted for using the equity method. This subtotal is included as an IFRS specified subtotal, so the disclosure requirements for management defined performance measures are not required for this specified subtotal.
Thanks very much, Bertrand. And now if I'd like to move on to the third and final of the main categories, so that is the financing category, which includes income and expenses on liabilities. So IFRS 18 distinguishes between two types of liabilities, those that arise from transactions that involve only the raising of financing and other liabilities. So to distinguish between these two types of liabilities, a company considers what is being exchanged in the transaction. If a company receives cash and later returns cash, such as with a loan contract, then the transaction is a transaction that involves only the raising of finance. If a company exchanges something else for cash, such as a lease liability that exchanges a right-of-use asset for cash, then it's an other liability. And for those liabilities that involve something other than the raising of financing, it is only the interest expense and the effects of changes of interest rates that are included in the financing category. For those liabilities that arise from transactions that involve only the raising of financing, such as the loan contract, it's all the income and expenses from the liability, including incremental expenses on recognition and derecognition, such as transaction costs, that are classified in the financing category. Examples of other liabilities are payables for goods and services received, decommissioning provisions, and pensions. And it's very important to note that for pensions, it is the net interest expense or income on the net defined benefit liabilities or assets that would be classified in the financing category. I will not go into the details today of the requirements for entities with specified main business activities, because we have a separate webinar on them next week. But I would just like to briefly touch on, just provide sort of a high-level overview of how those requirements work. So the model that we've just described would prevent some companies, such as banks and insurers, from presenting their key operating performance metrics in operating profit. So IFRS 18 includes specific requirements for when a company provides financing to customers or invests in assets as a main business activity. And these requirements would require companies with those specified main business activities to classify specific income and expenses in the operating category that would otherwise be classified in the investing or financing categories. So in order to apply those requirements, a company is required to assess whether it has specified main business activities. And a company uses its judgment in this assessment, and you would assess whether you invest in assets or provide financing to customers as a main business activity. That assessment must be based on evidence, so it's not just an assertion, it needs to be based on evidence. And in general, investing in assets or providing financing to customers is likely to be a main business activity if the company uses operating performance measures such as net interest income or net financial result as an important indicator of operating performance. And evidence that a performance measure is an important indicator of operating performance includes using such measures to explain operating performance externally or to assess or monitor operating performance internally. And information about segments may provide evidence that investing in assets or providing financing to customers is a main business activity if the entity is subject to the IFRS 8 requirements. And I see we're already on the next slide, which is talking about the classification of foreign exchange gains and losses. So a company classifies foreign exchange differences in the same category as the income and expenses from the items that gave rise to the foreign currency exchange differences, unless doing so would involve undue cost or effort. So the slide does contain a couple of examples, and a company classifies the foreign exchange difference on, for example, receivables for sale of goods in the operating category, the foreign exchange differences on debt issued in the financing category, and then for income taxes, it would be included in the income tax category. I think that is largely, and then if it will involve undue cost or effort, a company instead classifies the affected foreign exchange differences in the operating category. And a company assesses whether classifying foreign exchange differences involves undue cost or effort for each item. And that assessment is specific to the facts and circumstances related to each item. But if the same facts and circumstances relate to a number of items, a company could apply the assessment to those items in aggregate. So we've covered a lot of ground on subtotals and categories. Bertrand, can I turn over to you for your reflections on the subtotals and categories required by IFRS 18?
Thank you, Ran. I will start by acknowledging that as a preparer, the new requirements will result in changes, some of which, and I should say sorry, as a former preparer, the new requirements will result in where systems, IT systems will need to be changed. There will also be a need for companies to adapt their internal control processes and educate their stakeholders internally and externally on the new structure of the statement of profit or loss, something we know is not always easy. However, there are benefits that will come from having global comparability in the statement of profit or loss. Having a comparable structure benefits all stakeholders, giving a common understanding of where to find specific items and common starting points for analysis. It means being able to compare the financial statements of all companies that report using IFRS accounting standards wherever they are in the world, which of course will ultimately benefit the quality of the information analyzed by investors. Nick, shall we continue on to the next topic, MPMs?
Before we do that, Bertrand, we would like to share some views of our
Sure, Michael, of course.
And before I hand over to our first panelist, first of all, let me say thank you for the presentation and the introduction to this topic. To all of our participants, please bear in mind that keep log on to Slido, upvote your questions as we will then address them in the highest priority. So give your votes to the questions that you seem most relevant. So with that being said, I will hand over to our first speaker out of our experienced preparer community, and that will be Eva. Eva, floor is yours.
Good morning to everyone. So thank you for inviting us. We had it was a great experience to us to start in 2020 to start working with you on the first draft of this standard, and I must say it was very informative. We've learned a lot. We did a lot of exercises with our chart of accounts, and that would be the main thing in my opinion, the companies should start with. To rethink the chart of accounts they have already. But to do this, they should, first of all, it was said before, assess whether they invest in assets or whether they provide financing to customers in order to disclose or in order to categorize the assets and liabilities as well as expenses and incomes into the categories we're gonna disclose in the new profit and loss statement, which I confirm, although it might be hard at the very beginning, it needs time for the company to prepare, but for sure it is more informative, not only from the perspective of investors and those outside the entity, but in our opinion, from the field test, I confirm it's much better even for the company not to mix investing and financing and have clear operational segment, which is also very beneficial the way it was defined in the standard as a residual. So you should start from the financing, from the investing category and define assets, liabilities that you want to include in certain category. And then at the end, you will get the operating category. Talking about reorganizing chart of accounts, which is, in my opinion, an obligatory element of preparation for this standard. There should be also paid attention to how we see receivables because they, and this is mainly due to the foreign exchange gain and losses. What I mean is that, as you heard in the presentation a couple of minutes ago, gains and losses shall be split between the segments based on the transaction that gave rise to certain gains and losses. And gains and losses are mainly linked to receivables and liabilities. So that should be seen or organized differently in chart of accounts. And moreover, liabilities are also very important from the perspective of how the financing segment is defined, because it's when you go deep into the text of this new standard, you will see that its main financing activity or financing category is based mainly on liabilities that give rise to getting money for the companies. To summary, as I said before, it requires some time, so I encourage all the companies to start as early as possible to get acquainted with the text of the standard. I think that the first exercise would be to see how the actual chart of accounts fits to the new segmentation, the categories we have. And the next thing that, in my opinion, it should be done even knowing that the starting date is 2027. So it should be done I would even encourage everyone to do the first exercise this year, but the latest next year, because mainly also because of the retrospective presentation. So starting 2027 means that you should be prepared for it in 2026. So chart of accounts, I would say, is a huge might be a huge challenge, but this is just one-time job, and then you're going to benefit from it. And the second thing that will require changes is the accounting policy. It was said that we have to, for example, decide about cash and cash equivalents, where we're going to disclose them, in which category it will be placed. So this also will have to be changed. But the final conclusion from it is not only investors will benefit, in my opinion, but also the entity will benefit. So it's worth doing. Although, I don't know if you noticed that, but the standard, the copy I have, the IAS1, that still is in force, had only 23 pages, while the new standard is more than 70 pages. So a lot of sentences, paragraphs to read and get acquainted. So the sooner you start, the better. And one more thing maybe you can explain to the audience we have today refers to the gain and losses, foreign exchange gain and losses, because it says it should be presented in the segment that gave in a segment where the transaction that gave rise to gain and losses arise from. So I did not find an exact answer in the standard, but that might be interesting to our audience, whether we shall present these gain and losses foreign exchange gain and losses. Shall we add them to, for example, employees' benefits or development costs, for example? Or you think, of course, it is possible that we add a separate line for them, but which one would be better? Is there an opinion on that among EFRAG or IASB members? Thank you. That's all from my side.
Thank you very much, Eva. And with that question, especially, do we need separate line items for the EFX effects? Maybe we'll circle back to our colleagues from the IASB, whether you have a definitive answer or whether that's subject to the company's judgment.
I suspect it will depend. That will be the answer. But maybe one of the team maybe wishing to explain that, following up what I'm about to say. I say depends because it depends the way the FX risk management is organized and structured within a company. It depends also which IT system you're using for various operational reasons. Quite well-known European ERP system forces you to follow on separate lines FX impacts attached to assets and liabilities. So if you have this, if you're using this ERP, you have obviously the information, and then you may be willing to present the information separately. But I appreciate that not all companies may be using such a complex ERP system. So Juliana, do you want to add to my first spontaneous answer?
Sure. And it's a bit jumping ahead because it feeds into this grouping of information and what provides a useful structured summary. So Bertrand, you're completely right. It really depends on the company. And we will talk a bit more about it later today, about the fact that the entity has to provide a useful structured summary of its income and expenses. And we have some principles for aggregating and disaggregating items, and that kind of evolves around aggregating based on similar characteristics and disaggregating based on dissimilar characteristics. So I think in the case that you've described now with the foreign exchange gains, and shall we add them to employee benefits, it will just depend. If presenting it separately provides material information and also contributes to providing a useful structured summary, then I guess yes, there will be cases where that is the case and you present it separately. But equally, there will also be cases where maybe an aggregated view provides the most useful structured summary. So there's like no right or wrong answer to this. It's just very entity specific.
Thank you very much. Thank you very much. So with that, thank you very much, Eva, for sharing your views and asking your questions. We'll now hand over to Margie, and the floor is yours.
Thank you very much. So also thank you for the opportunity to be able to speak today. As a general remark that will go to all of the sections and topics we'll be discussing today, I think what we want to say today is to be early and jump in as soon as you can. We are dating back to 2020 when we are first asked to work on this project and field test it. And it takes time. So I want you to have in mind to be very open-minded. Go to the IFRS 18, read it out, and try to do it yourself for the first time with your financial statement, and you will see all those pieces that you are missing somewhere. And that connects to the previous question, is that we can see from the standard that we need to apply judgment, and in a lot of places you will be able to see something which is my next question, is that there is a judgment that you need to do and possible simplifications to your financial statement. And in one of the places where you can simplify your financial statement is in the forex exchange gains and losses. It was shown in the IFRS presentation, on the EFRAG presentation, that the company can present all of the forex exchange gains or losses in the operating category if the separation of it would be involving undue costs. So basically it will be just a very big burden for the company. So my question, and something which I'm wondering, because it's already still early stages and we didn't see how company does apply it in real life, is with putting it inside the IFRS 18, are you afraid, or were there any concerns that the companies may try to broadly use the simplification because it's there? So, if a standard says you can do it, if it's undue, I'm just going to say it's undue and not do it at all. Or do you think that the judgment will win and we just need to emphasize more to say, please use your judgment, think about materiality, go back to the roots of accounting? That's my question.
Thank you very much, Margie. Who is willing to answer that, looking at the colleagues from the IASB? Although, Margie, as a personal remark, I would say we should invite some auditors to that discussion when it comes to the assessment of what cost is actually undue, as they will have an opinion about that. But Bertrand, team from the IASB, are you worried that that exemption, so to speak, will be made use of to an unjustified extent?
I'm not sure, Bertrand, maybe you look a little bit frozen, so perhaps I can pick up that question. So obviously, we had initially in the ED not proposed that undue cost or effort relief, but we'd received obviously from fieldwork participants, from comment letters, that for some entities they really did need that sort of relief because it would be prohibitively expensive to split up the FX gains and loss, given how the system is set up and how they manage the FX gains and losses. It's also important to note that the undue cost and effort relief, the unit of account is the individual item, so it's not all or nothing around whether or not you apply it. So there may be some items for which it is undue cost and effort and the entity can put it into operating, but it may be possible for some items or large ticket items, for example, foreign currency denominated loans in the financing category, where you could actually not need to apply that relief and actually classify those into financing. So it will be very, very entity specific. Obviously, we don't have any idea of how the market will actually respond to those requirements, but it was an example of where we try to find a practical solution that the requirements would work for all. And I see, Nick, you've raised your hands there if you'd like to pop in as well.
Yeah, I think I just wanted to add that, I mean, going back to Bertrand's comment earlier about the risk management processes, I mean, that what we saw in the field work, that's part of what really drove having the undue cost forever. We saw that different companies organized differently. Some we know break out that FX and the information is readily available, and they tend to manage those risks more directly on sort of a category or even an item by item basis, whereas others do it more centrally and their systems just are not set up to be able to provide the information. And so that's why the relief in kind, and I think that's what we have in mind in terms of undue cost or effort is, these systems changes would be required to get this information, rather where in a case where it's readily available, well, I think we would be expecting that wouldn't be applicable. So I don't think we're worried. I think it's there for those types of situations.
Thank you very much. Bertrand, you are back.
Yes, I'm back. Sorry about this. Just wanted to add to that, because you may be wondering why the default category is operating for those FX gains and losses if there is undue cost or if undue cost or effort applies to allocating FX gains or losses to each category. We heard critically from investors that they consider that FX gains and losses attached to the operating activities of the company needs to be within operating. And so we were considering this when deciding the default category for the accounting for FX gains and losses to be the operating category and not another category.
Thank you very much. So if I understood correctly, Juan, you said that the exemption to provide everything in the operational category is not a free ticket to put every FX effect into the operating category, but only for those circumstances where there are actually undue cost and effort. Is that correct? Thank you very much. So coming maybe from the FX effects to a bit more interest-related topics, you have explained also about the main business activities and what the differences in the categorization may bring with it. And I believe if we hand over the word to Andreas from Volkswagen, which is a conglomerate with its own financial services division, do you want to share your experience and ask a question, Andreas? Floor
yes. Yes, thank you, Michael, and thank you, EFRAG and IASB, to be here on this early stage to have an opportunity to hear your view for a better understanding how we have to reach the standard. As a typical in the automotive industry, as Michael just mentioned, Volkswagen Group has two main divisions, automotive and financial services, and not surprising, we think that the regulations to entity with main specific financing to customer will apply to Volkswagen. IFRS 18 provides for these companies some accounting policy choices, for example, not to differentiate between debt belonging to the financing to customers and other debt costs. So what we ask ourselves, we would like to use this accounting policy choices for our financial services division. But what does it mean for our automotive companies? Do we have to use the accounting policy choice there too and show all the cost of debt now on the operating income? So it would be good if you could answer this question.
Thank you very much, Andreas. Juan, I see you unmuting. Are you going to take the lead?
I'm happy to take the lead, and then if anyone else from the IASB side wants to jump in, that's fine. So the way the accounting policy choice works is you assess at each reporting entity level. So in the subsidiaries accounts, you would assess whether you provide financing to customers at the subsidiary level, and the group accounts you would assess at the group level. And those outcomes of those assessments may differ. I guess in the consolidated financial statements, one thing to note is that there's a link to the segment reporting in IFRS 8. So if you have a separate financing segment or reportable segment for financing activities, that would mean that that is a main business activity of the group. The accounting policy choice is either to classify the income and expenses that relate to providing financing to customers in the operating category, or so that is required if you reach the conclusion that it's you'll provide financing to customers. Then there's accounting policy choice around those income and expenses from liabilities that don't relate to providing financing to customers. So that's where that accounting policy choice comes. Generally, for the an automotive type entity that's got financing attached to it, we would expect the only the income and expenses from the liabilities that relate to providing financing to customers would be classified in the operating categories. So that would generally be the liabilities coming from that subsidiary. Those income and expenses would be going into operating. We wouldn't expect, and I think it would be almost quite misleading if you took up all of the liabilities, including those liabilities that relate to the financing of the automotive segment as a whole. But hopefully I've answered your question, but I don't know if Nick or Bertrand would like to add anything to what I've just said there.
So sorry
I think it was clear from my side.
Sorry, only to be clear, you say, okay, I have to do the accounting policy choice on group level. So we have to do it for every financial services companies the same, but that does not mean that we have to do it for all companies the same, right? If we have an automotive company, they can provide it still in financing result, and only the financial services can make this accounting policy choice. Correct?
That's correct. So if you had a subsidiary that's not providing financing to customers, it's that subsidiary is fine for those income and expenses related to their liabilities to remain in the financing category. That's what we intended with the accounting policy choice.
Okay, thank you. I have a second question. This relates to the assessment. You already showed that we go through our companies and look what activities we have, and you have listed several activities you could have. We have them all. But however, we would say, oh, not every activity we have is a main specific activity. So you also showed there are two indicators how I can decide if an activity I have is a main specific activity. However, when we try to apply it to our group, we found it really complex to do that and didn't say one of both would fit. Would it be possible to use other indicators to decide by a management assessment, or are we bound to the both you provided in the standard?
So what we put in the standard, I think, is examples of the indicators that can be used to apply. Obviously, an entity needs to use judgment and provide evidence of those indicators. At a very high level, what we're aiming for with those indicators is that the margin that comes from that activity, if it's a key operating performance margin and you're managing that margin internally, you're talking about it externally, then that indicates that it's a main business activity of the entity. You could have examples of where you have an activity. It's just something you may be doing as part of your business activities, but the margin itself from that activity may not be something that is a key indicator of your operating performance. So in that case, you're more likely to judge that in that case that it's not a main business activity. So what we were aiming for is really what is the key margin coming from that activity, and is it something that you're managing internally and then talking about it externally to investors because it's a key indicator of operating performance.
And to add also that if it is an operating segment, of course, it's also, for instance, an example that could lead you to consider that it's a main business activity. And maybe your question goes also in relation to the presentation, and there it depends also at which extent the information is disaggregated in the operating segment note. But there is obviously an interesting interrelation between the primary financial statements, the P&L, and the operating segments. Then it can be also presented on the face of the consolidated financial statements. You could have a series of distinct subtotal following up. And to mention also that we are not precluding a presentation by column, which probably in this instance also on the face of the P&L, I mean, which in this instance could help eventually for the presentation of of the various activities you may have if in the case of a conglomerate.
Yes,
just to add a bit more color to Ran's answer.
Yeah, I understand what you mean, because we do it today already in the management report. You present it by segments, so it's better understanding. Only to the indicator that I get it right again. You say if it's operating result, if it's part of the operating result today, then it will be in the future, because then this is more or less a self-fulfilling prophecy if I have it already in operating performance today.
It's quite a difficult question to answer, but generally, if today you are talking about that particular business activity because it's a key indicator of operating performance, then I think your conclusion would be that it's a main business activity applying the requirements of IFRS 18. But without actually looking at the details, it's a little bit difficult to answer the question yes or no.
Okay, thank you.
Thank you very much. Yeah, and I'm looking a bit at the time, and we're already a bit in the overrun and not even having asked some questions from our participants. But before we go to the participants' questions, we have Francois coming in with a question around the at-equity accounted investments. Francois, floor is yours.
Thank you, Michael, and good morning, everybody. And maybe just to as a very quick introduction, when it comes to categories, subtotals, but the other requirement of the standard, we have really appreciated the development of the standard over the last years. We obviously spent a bit of time on the exposure draft, which was published in 2019. And we have followed very closely all the developments, and I think that really helped us to prepare the changes which are coming. On categories and subtotals, maybe the first comment or basic reaction when I discussed this with the management in my company is people just ask if there is a consequence on the KPIs which are used by management for the monitoring and management, obviously, of the business. And we have really appreciated the fact that the IASB came with a very well balanced, in a way, standard, in a way, by defining clear categories, yes, but still preserving the judgment of management when it comes to the KPIs. And here I'm touching a bit of probably the next topic, which will be management performance measures. So I think that's really something that needs to be reiterated, to the fact that we have a rather strong framework with operating, investing, financing, but still judgment applies, and the KPIs of management will be respected. That's our reading of the standard. When it comes to equity or associates and JVs under equity method, I think that's typically an illustration of our first reaction when we read the standard and looking about this introduction of integral versus non-integral, which for us was a bit of not a surprise, say, but we did not realize that maybe there was this diversity in practice. For us, associates and JVs under equity method are presently separately. They are not part of our operating profit, nor part of the regular KPIs managed internally and externally communicated. Clearly, that was one of the potential source of complexity we have detected, that we would have to make a distinction, which would, for us, not be relevant. And we really welcome the fact that the IASB at the end moved a bit the position by recognizing that maybe there is a distinction here which is a bit judgmental, difficult to assess. And here it makes a link with what I said before, is that although integral, non-integral would be grouped in the same place in the income statement, the management still has whole possibility to preserve an existing KPI, which includes some of the results from this associates and joint venture. So we really welcome this, again, respect in a way in the standard, and not forcing companies to have dramatic change in their KPIs. So that's, I think, just to, in a way, share a bit our reaction. It's just one example, but we have detected also maybe when it comes to categories and subtotals. I said before that the first reaction of management is, does it change our KPIs? We have KPIs obviously related to operating profit, but we discussed about, or the IASB discussed about the cash and cash equivalent with impact in investing, whereas the cost of the debt would stay in the financing category. Obviously, in some companies, there can be a sense of cost of net debt. And it's very possible that, therefore, the structure of the existing structure of the income statement was already, in a way, defined to present naturally a kind of net cost of the debt. So that's something that obviously will have to change, because management in that case will probably have to come with another MPM, I guess. But again, I'm jumping on the next topic already. So yeah, so that's what I wanted to share as a reaction, as comment on these categories and subtotals. Fortunately, in my organization, we are not a conglomerate, so we have probably less of these indeed very challenging questions, which are specific to conglomerates and the identification of main specified business activities. But it doesn't mean that there is no questions, obviously. And when we go to the details, we also see that some of these items may require a bit of judgment. And I think maybe a typical question is on ethics on IG loans. We know that's a question which comes frequently. So that's it for me at this stage on categories and subtotals. Thank you very much.
Thank you, François. Bertrand, you want to come in?
Yeah, just thank you, François, for your nice comments on the standard. Most appreciated. On your last comment saying a bit of judgment, I think there will be plenty of judgment, not just a bit of judgment, and pretty much all requirements in IFRS 18 will require judgment to be exercised by companies to appreciate where they will have to present the financial information. We have set principles, not rules, and so judgment then will have to apply based on the specificities of each reporting entity. So I do acknowledge that, but then obviously what we also heard from investors is do not impede companies to provide entity-specific information, which we are heavily interested in, but please provide some structure and some rigor so that we can have some form of comparability from one company to the next. But judgment will prevail. Yes.
Thank you very much, Bertrand. By looking at the time, it's now time for us to answer some questions that our participants have asked us. And for the avoidance of doubt, we're now going to address the questions asked by the participants regarding the topic categories and subtotals only. So if you have questions, ask questions to other topics, those will be addressed in the respective section, and we will then archive all questions that we have on this topic to make Slido a bit easier to read. So where to put effects in the statement of profit and loss? That is our first topic, and we're talking about internal loans now. intra-group loans with FX effects. And the question is, where should we post those effects in the statement of profit and loss? Which category would you foresee for a transaction that is actually eliminated?
Yes, because the requirements are such that effectively, if the loans is an interco transactions, the FX gains and losses attached to the loan are not eliminated. Indeed, and there is a kind of mismatch between the CTA accounted for on one hand, on one leg, and the P&L effect on the other, in the consolidation process, I mean. It's a difficult question to answer, and there it fits nicely to my previous comment on judgment, and I would say it really depends of the structure of the group and of the organization of the FX risk management, and above all, it depends on which reporting entity we are talking of. And Ron alluded to that in saying in individual financial statements of the subsidiary or of the reporting entity, or in the consolidated financial statements. So maybe and I know it's a super oversimplification of this. Let's assume the FX risk management is borne by the operating unit, and there is a direct connection without treasury ups in between to simplify things. And there's a loan in the currency of the mother company that is lent to a reporting an operating entity for which there will be an FX impact. Then obviously, if we consider the individual financial statements of the operating entity of the subsidiary, then obviously it's a financing, and the FX will be accounted for in financing. Now, if we are considering in that case and the mother company has no FX gains or loss to account for, obviously. If then we are considering the opposite, i.e. a loan granted by a mother company in the foreign currency of the operating entity of the subsidiary, and then we are considering the mother company as the reporting entity, there is an FX gain or loss then at the at this reporting entities level in the individual financial statements of the mother company. And obviously, it's as it is a loan, it would be probably in investing the FX gains and losses. To be mentioned that generally the treasury department of the company of a group manages the FX risks and the FX positions of either the subsidiary in my first example or the mother company in the other one. And obviously, through netting and hedging, there is generally a corresponding effect, FX gains and losses attached to hedging instruments that will be accounted for in the same category as the FX gains and losses of the internal loan. So then when it comes to the group, it's where the question may be probably also interesting. Generally, if the group is effectively, in my second case, which is most often what I've encountered, i.e. the FX risk are centralized at the group level, so that the group treasury department is managing the FX risk position for the group through netting and hedging. Then obviously you have no FX gains and losses to account for at the subsidiary level. All is centralized at the central level, and effectively, if you consider the consolidated financial statements, all this is about financing for the mother company. So there could be an argument saying that even those FX gains and losses could also go to financing, because there will be a matching often with if companies is doing balance sheet hedging, for instance, then there would be a natural matching within the P&L of the FX gains and losses of the external loan vis-à-vis the markets that the mother company has received, and with the internal loan they have granted to their subsidiary. So it's a very brief answer to a very complex matter, and the answer basically is it depends.
It depends. Okay, and I'll take that and the judgment as a topic that we will see every now and then when applying the standard. Thank you very much, Bertrand. Nick, you may come in, but I would ask you to be brief since we're really in the overrun in time.
I appreciate it is completely my intention to be brief, and just to highlight, I think what Bertrand has outlaid is some ideas around situations that you could apply the principles. I think there's two key principles, or maybe three, if I will, that are to be remembered here about the FX. It's classified in the category in the same category as the assets or liabilities that give rise to the expenses. So I think if you can find those assets and liabilities, that gives you the guide. Bertrand has talked about some of the challenges you might have. There's also the undue cost and effort. If that is too much of a challenge, it can be in the operating category. And there's also a final, the way that operating has been designed, if there is no specific guidance, so if you just cannot figure it out, operating is the default. So I just put those out there as sort of high-level things to not get too worried about getting into the weeds about that, but those are the principles that you'd be looking at.
All right, thank you very much. Now moving on to cash and cash equivalents, where we have talked about that some companies may see the return from cash and cash equivalents as part of the net debt cost of net debt, so more a part of the financing category. The standard tells us that it should be part of the investing category. Now we have a question: why is it not operating? So is there a brief answer you can give to that? A real brief?
Yes, there is a very brief answer. The reason is because it's not a proper financing, in the sense that investors were requesting from the board to have a financing result that relates to the gross financial debt of the company. So therefore, we contrary to the exposure draft, we reclassify in the final version of the standard the cash and cash equivalents impacts into the investing category. And we will cover, because it will be certainly a question we can cover, but Nick, will need to present the section on MPMs prior we answer this question, if it is of interest for the audience, on the presentation of net debt and net interest expense.
Thank you.
I think also, just to add to Bertrand's point, so in the ED, we had proposed to put that into financing. We had a lot of feedback that was quite difficult to distinguish between things that should go into financing and things that should stay in investing. So for simplicity purposes, the board decided that cash and cash equivalents would go into the investing category. The arguments were quite finely balanced as to where they went. But also the board made the decision not to require entities to distinguish between cash and cash equivalents used for operational purposes and those that are like excess cash or for other purposes. So it was more to make the requirements simpler to apply, that entities don't actually have to distinguish between those that are for operations and those that are not.
Thank you very much, Ron. All right, last question, and then we're moving with, meanwhile, a lot of delay to the next topic, and apologies for that. And we have one question that says, for pensions, only the net interest must be shown in the financing category. What about service costs? Can they remain in operating? Brief answer?
Yes.
Yes.
Yeah, great. Great. So with that, we have not covered all the questions that have been posed. Thanks to all the participants for asking your questions. We have to move on to the next topic, which is management-defined performance measures. Thank you to all your input already, and now looking forward and handing over to the IASB with their presentation. Thank you.
Great, thank you. So continuing on with the management-defined performance measures. So I think as Francois alluded to a little bit and Bertrand pointed out at the beginning, the management-defined performance measures very much work together with the defined structure. So where the defined structure gives comparability, the management-defined performance measures complement that by giving the entity the opportunity to give more entity-specific information within the financial statements. Now, we know many entities today use what in Europe we would refer to as alternative performance measures or APMs. And investors told the IASB that they find the information about those measures very useful. It gives them insight into how management views the performance of the business, and they find that information very useful. But they also raise concerns around the consistency of the information that they get, and I take that feedback as looking across what they get globally, and different regions have different requirements. And so the information coming through is sometimes it's certainly not in the same place, so it's sometimes difficult to find. Sometimes the information is simply not available, and sometimes it can change from period to period without much explanation about what's happened. So what the IASB has done in response to that is to include requirements to include a subset of these management-defined measures, what we have defined as management-defined performance measures, within the financial statements, within a single note, and then to require specific disclosure requirements to give more transparency around those measures. Now, the measures that are included as MPMs are a subset of what we will know as APMs today. That there we go. My slide has finally moved on. So that subset is very much tied to the objective of the project to focus on performance reporting and in particular the statement of profit or loss. And so on the slide that you see in front of you on the right hand side there, we can see that some examples of what will be management-defined performance measures and some that will not. And so because it's based on this performance and as I say, very much the statement of profit or loss, things like an adjusted operating profit would be a management-defined performance measure, whereas something such as a free cash flow or return on equity, a measure that's based on something other than the statement of profit or loss, will not be within the scope. So we see very much that APMs will continue to exist outside the financial statements as they do today, and it will just be this subset that comes within and is subject to disclosure requirements. So to get that link to the statement of profit or loss, part of the definition, so we have on the slide the three parts of the definition of a management-defined performance measure. And that first part, as I say, the link to the statement of profit or loss is that they need to be subtotals of income and expenses. The second part of the definition is that they are measures that are communicated outside of the entity's financial statements in public communications. So the idea here being that they're not a new set of measures that need to be created. There's something that exists today outside the financial statements, and the idea here is to capture some of those measures and to bring them within the financial statements where there can be disclosure requirements for them. And then the last piece of the definition is that they are something that communicates management's view of the entity's performance. And as I said, this is the thing, or at least one of the key things that investors found very useful about these types of measures to understand management's view. And so it's a part of the definition. Now, there's a little bit of a tension between management's view and public communications. And so within the standard, there is a presumption that if an entity communicates something in its public communications, it's done that for the purpose of communicating management's view. It then goes on to give some guidance to say, if that's not the case, if an entity has reasonable and supportable information that it has communicated a measure outside its financial statements for a reason other than communicating management's view, and there's information to support that it indeed does not communicate management's view, then the entity can rebut that presumption and would not have that as a management performance measure. And so an example of this might be if an entity had a measure that is required to be included in a public communication by a regulator. It doesn't use that measure internally. It could then put forth this rebuttal, and that would not be a management defined performance measure. So the disclosure requirements are probably very familiar to many of you because they're very similar to what we have with the APM guidance today, and really aim to bring transparency around the management defined performance measures. And so the key one is a reconciliation back to the most directly comparable IFRS defined subtotal. So if you had an adjusted operating profit, you would be reconciling that back to operating profit as defined within IFRS. A key change from what preparers will be used to today is it will be a requirement for each of the reconciling items within that reconciliation to disclose the non-controlling interest and the impacts and the tax impact of those adjustments. So in addition to that reconciliation, some narrative disclosures are required, an explanation of why the management defined performance measure has been reported. So what information is it communicating? Obviously, how that management defined performance measure is calculated, and then any explanations of changes. So if there's a new management defined performance measure, if one's removed, if that's how that's calculated been changed, the entity needs to disclose why it's done that, what's the effects of that, and provide comparative information. So to just briefly look at what a reconciliation might look like, we've presented this in a columnar type format. That's not a specific requirement, but what is to link back the individual adjustments to the line items that are affected within the statement of profit or loss. So if we look at the adjusting items of the impairment losses, restructuring, and the gains on the disposal of PP&E, we can see within this columnar format, these can easily be linked back to each of the line items within the statement of profit or loss. We then have, of course, the two line items as rows that I suggested about the income tax effect and the non-controlling interest. And this obviously reconciles from the IFRS measure to the management defined performance measure. So with that, I turn it back to Bertrand to give you some thoughts from the why the board had these measures and what the benefits we think we will achieve.
Thank you, Nick. When companies use performance measures outside the financial statements that are company specific, it is much important to understand how they are being calculated and what they are designed to communicate. Each company will have their own particular ways of calculating measures that can be described in similar ways. The requirements for MPMs make it easier for investors to find the information needed to understand these measures, and will make sure that they are always transparent. Because they will be in the financial statements and subject to audit, investors will be able to have more confidence in these measures and understand how they compare and how they differ between different companies. The information provided will also be the same regardless of the jurisdiction, so it will not be as dependent on the regulatory requirements, which can differ by region. And that was an important feedback we heard from global investors. These benefits are something we heard positive feedback on from both companies and investors, as companies will now have a tool in the financial statements to communicate their company specific information in relation to the P&L. Thank you.
Thank you very much, Nick. Thank you very much, Bertrand. Very good insight So with that, I'll hand it over to our next panelist. Lars, over to you, and I believe you will bring that in connection with the ESMA guidance on alternative performance measures. So, floor is yours.
Exactly. Thank you, Michael, and thank you for providing me with the opportunity to attend today's panel. So indeed, as Nick clearly explained, if we look at the scope of the management-defined performance measures under IFRS 18, the MPMs, the scope is limited to subtotals of income and expense. This is a more narrow scope than what we see under the ESMA guidance on APMs, where the alternative performance measures also cover measures related to the financial position of a company or cash flow measures. So especially since the disclosure requirements under the ESMA guidance are also very similar to what is now required under IFRS 18 with respect to the MPMs, I was wondering why still such a narrow scope or narrower scope has been chosen by the IASB in defining the MPMs.
That's a very good question. And I will provide much a personal feedback on this one. At this stage, effectively, MPMs apply solely to alternative performance measures currently used by companies in the P&L, in the statement of financial performance, and not the balance sheet or not the cash flow statements. We should start a project on statement of cash flows, and no doubt that we will then consider within the boundaries of this project the instruction for alternative performance measures in the statement of cash flows, or presented in generally the management cash flows, and probably the same for the balance sheet. So I ask you for a bit of patience there, so that we can tackle the issue with you guys in the coming months, years. And then a last piece of comment in the meantime. You were referring to the ESMA guidance. That's very true. My personal sense on this is that what we have put in the standard is relatively close to the current practice that is undergoing in Europe currently with the application of the ESMA guidance. There are small nuances, so you will have to pay attention for some details. The fact that we have said explicitly that MPMs are IFRS-based measures, for instance, but which may generate some slight differences or nuances. And we have already exchanged with ESMA, and they are pretty well aware of that. That effectively there will be in the meantime need to be a coexistence between an ESMA guidance for APMs in relation notably to those MPMs in the P&L that are not MPMs in applying IFRS 18, and those alternative performance measures for the balance sheet or for the cash flow statements. So hopefully it answers your question, and it gives a bit more broader context to that within a European context, which is the interest of today, of course.
Clear. Thanks, Bertrand.
Thank you, Bertrand. Nick, you want to come in?
I'd like to just add, I think even within a European context where we're quite familiar with adjusted measures as a whole, I think it is a quite new idea to bring them within the financial statements where they'll notably be subject to audit. And I think in the early days, at least, there was a lot of hesitation about doing this. And so I think we're taking some first steps here, as Bertrand has suggested. And I think it's important to note that is a bigger step in some jurisdictions than maybe it is here. And so we have to sort of, I think, just keep that in mind. And I think also once the evolution happened, and we got feedback that this was, well received by many stakeholders, which, as I say, it wasn't necessarily at first. There was a realization that to get the requirements around disclosures and scoping in place and right for the other types of measures, that was going to take a lot of work. And there was also a demand to get this standard out as soon as possible at that time. And so the board made a decision to just keep focused on the statement of performance, on performance measures, and keep find a balance between both that time bound, but also respecting how far we're already going, as this is seen in some areas. So I think we tried to find a balance there to keep it, and that's why we end up with this focus.
Thank you very much, Nick. So I'll take it that there is more to come on management performance measures in the future. Thank you very much. So we'll move
there
on.
may be more consideration. We will certainly consider it. I'm not committing to anything at this stage.
Understood, but we'll be happy to discuss, Bertrand. So then we have seen, of course, the reconciliation, including the tax effects of any adjustments. And for that, I will hand over to Margie again, and you will report to us your experience.
Yeah, thank you very much. So
maybe before you start, let me remind all participants, stay logged on to Slido and vote on your questions and pose your questions there so we can then ask them to the IASB. Thank you. Now, Marty, sorry for the interruption. Floor is yours.
All good. Thank you very much. When we are doing the process for the first time and doing it then for the second time after 2 years, we really liked what the IASB and EFRAG and what the standard itself has changed, alike within the 2 years, because the tax effect was bothering us a lot when we were looking at the IFRS 18, especially from companies that have special tax rebates. We are part of special economic zone, and looking at the tax effect and trying to apply it per each item that was reconciled in the MPM was very difficult. So we really liked the simplification that allowed us to calculate some reasonable pro rata allocation and use it for all the items that we are reconciling, and that really helped with preparing and taking the burden off the preparation. So looking from our perspective, I think from the preparer's side of view, really you need to look for the tax effect, and if it's very difficult, like in our case, to use it for every single item, then the simplification of pro rata allocation is very nice. So I really like that, hands up. But I want to emphasize when looking at the MPMs that you need to really look what an MPM is currently. It was already spoken, so it's very narrow category, and it brings me the question or the wonder that it is first of all maybe confusing for some users, I mean, first of all, to preparers, what will be the MPM, what I will show as an MPM, and we need to understand that if somebody is a subcategory of profit and loss, it is not an MPM because it's already presented in the P&L. So we need to, have it in our mind when thinking about MPM and presenting them. But then, from the user's point of view, I feel that some of the users that may be not that deep into IFRS 18 may at first get this impression that those 3, 4, whatever the amount of MPMs will show in the financial statement are what are actually all of the management performance measures, which is not the case, obviously, and we've talked about it now. So my question, I guess, is should the companies start disclosure, the note about the MPMs, by specifying that we consider other things as our performance measures, but they are not falling within IFRS 18, so be aware of that. Is it really needed, do you think, or will everybody be so familiar with the IFRS 18 that there will be no problem with that? Or maybe also specify that, for example, some of the subtotals that are within the P&L are what we as a company consider MPMs, but the performance measures, but we don't need to disclose them more deeply because they are already presented in the P&L. So what are your thoughts on that?
Thank you very much, Maji. Who is one in Bertrand?
Yes. I think in the note to the financial statements, I would, and I will let Nick confirm what I'm saying currently, but I would expect the note to be focused on MPMs. But then once again, it will depend because some companies can present today alternative performance measures on the face of their primary financial statements and in the notes to the financial statements, and some other cannot. Depending on what was accepted by the auditors or the regulators. So it also depends of that. But spontaneously, I would expect the note to the financial statements relating to MPMs to focus on MPMs, except if eventually the alternative performance measures are also presented in the primary financial statements or in the notes. But there, I think it will be crystal clearly super important for a company to really differentiate the information in relation to MPM prepared in accordance with IFRS 18 from the rest of the alternative performance measures. And of course, there is no issue if the alternative performance measures are presented in the MD&A report, for instance, and not in the primary financial statements or in the notes. I think the requirement that is crystal clear or that is critically important, is that the information on MPMs needs to be located in a single note. So I think that probably is the main important aspects. So applying also the principle of aggregation and disaggregation, it would be a bit contradicting all those principles if all of a sudden in these notes for MPM there were mixed information presented for MPMs in accordance with IFRS 18 and for alternative performance measures, which are not MPMs. So I will really that's a spontaneous reaction, and please, Nick, add or correct or amend or nuance what I'm saying, but I would critically separate the two, not necessarily into distinct notes, but at least in the notes when it comes to performance measures to critically isolate the information on MPMs from any other information on alternative performance measures, which will not meet the definition of MPMs. So we have been clear. Nick?
Please come in.
Nothing to correct. Maybe just to add, I think to appreciate the situation we have today, at least as investors have told us, is the information isn't all in one place and easy to find as it is today. So I think there's confusion out there as it is. Now, because we're only a subset, bringing only that subset into the financial statements makes it better for those, but not necessarily for the rest. So I think it's an improvement, maybe not all the way. I think, though, also, I think you make a good point that there is a space for voluntary disclosure, but it would be voluntary disclosure, so there wouldn't be a requirement to point to others. But I could see it being good practice to say, these are our MPMs, as Bertrand said, being very clear as defined in the standard. We disclose other measures that we find important in our management report, for example, and pointing users there to make that link. But it wouldn't be a requirement. It would be purely voluntary.
Thank you very much, Nick. I think very interesting. Maji, you want to come in again?
Just one sentence which I forgot to add before the question, which I think was very important from the preparers and users' point of view. I think it is very important to remember when MPM from preparers' point of view, you may really need to think how you want to create the note, because it was very complicated at first when we tried to make all the adjustments to not make it 2-page long. So think about it beforehand, because you really need to prepare everything before the 2027 to be able to present the MPM in a clear, informative way. And from the user's point of view, you need to remember that if somebody says adjusted operating profit, it may mean something different than adjusted operating profit from another company. So as was said in the presentation, it will not be completely comparable, but you can see the reconciliation. Just, two notes that I think are important here. Thank you.
So you say it may not be completely comparable, but you will know what the difference is. So thank you very much to all of you. Now we have some questions from our participants, which I would like to ask to you. The first one is about a company reporting the EBIT, earnings before interest and taxes, as an MPM. And the question is, would that reconciliation effort need to be done for the group EBIT, also on the group level only, or also on the operating or the reportable segments that are presented in accordance with IFRS 8?
Sure, I think there's a very easy answer to that one, and that no, it's only on the group level. So there's a bit of a nuance to the definition, which I didn't get into within the presentation, that it's presenting management's view of the entity as a whole, and so that where you have those subdivisions that are just adding up to the measure as a whole, those subdivisions are not required. It's just the EBITDA for the entity combined.
So it's the reporting entity level, you say?
That's right.
All right, thank you very much.
But if you are disaggregating, because some companies are doing that currently, disaggregating in the operating segments notes their P&L up to the operating profit generally by segments, then you would of course be allowed to disaggregate whatever MPM you are presenting on the face of the P&L into the operating segment note, of course.
Thank you very much. That depends on whether you have, for example, tax effects also pushed down to the reportable segments level. All right, so next question, and in the sake of time, I'll remind you that a brief answer would be quite nice, but be as thorough as you think useful. So about outside public communications, outside of the financial statements, do management interviews in newspapers and magazines meet the definition of that kind of outside communication? We can, I think, add TV interviews to that. What would you think?
So I can say that there is some guidance in. So public communications, we have not defined specifically, as this may sort of vary jurisdiction by jurisdiction about how that looks. But what the standard does is give some things that definitely are, and that includes management commentary, investor presentations, and press releases. And then it gives some things that are definitely not MPMs, and so that's oral statements, transcripts of oral statements, and social media posts. And the reason being, we think that the measures that are usually communicated in those types of media are usually already communicated in something more official, like a management commentary or an investor presentation. So so those are sort of the bounds, but otherwise it's a bit of an open question. What's the public communications outside of those?
Right, so you're saying we don't need to put our CFOs on the leash when doing some external interviews. That's great. Next question is about the adjusted operating profit. If that is considered an MPM, can it be kept as a subtotal in the statement of P&L? And I would assume that the question refers then to operating profit rather than adjusted operating profit.
I think to be presented on the face, because the question is really about should MPM be presented, or can MPM be presented in the P&L, more broadly speaking, or should they be only disclosed in the notes to the financial statements? And there, to be presented on the face of the P&L, the MPM needs to follow the natural order of presentation of the categories and of the revenue and expenses within the category. So I can preempt this question. So typically, net interest expense because it is a metric that combine expenses in the financing category and income in the investing category would not be able to be presented on the face of the financial statements because there you would not follow the natural order of presentation of the line items in the P&L. But of course, it may be disclosed in the notes to the financial statements if it were to be considered as an MPM. And you may find useful that in the basis for conclusions, there are some consideration provided as to when eventually a net interest expense, such an aggregate net interest expense may be considered as not being an MPM, rather a subtotal. So that's something I would like to point the audience to, because I know it may be important for some.
Thank you very much, Bertrand. Next question is something that we already touched upon, is how much other non-MPMs, so APMs that are not considered to be MPMs, can I put into the financial statements? Nick, you already mentioned that investors have been concerned that they don't find all the information they need in one place. So is there a limit on the content or on the amount of information about non-MPM, so APMs outside the scope of IFRS 18, to be put into the same single note for explanation? Is there anything you can say about that?
I may take a first try on this one and let Nick follow up on this. This is not a question of what IFRS 18 is saying on that, because IFRS 18 just mentions MPMs and only MPMs, as Nick mentioned earlier. There, the question will be in relation to the regulation and the interrelation of the company with its auditors and regulator, basically the market authority in many circumstances. So there are circumstances whereby a company is precluded from presenting alternative performance measures in the P&L or in the primary financial statements or in the notes to the financial statements, and therefore all the guidance, and that's what we mentioned when we describe or when we presented the slides. All we were trying to say is for those companies, it will be an improvement that certain current alternative performance measure will, with the application of IFRS 18, be either presented on the face of the P&L or disclosed in the notes to the financial statements. And there are other companies for which effectively the alternative performance measure are either presented in primary financial statements or disclosed in the notes to the financial statements. For those, then it goes to Nick's earlier or previous answer in saying that then there's no requirement in IFRS 18 attached to that. There, it's the ESMA regulation that will continue to apply, and the only request by IFRS 18 is to isolate the information relating to MPMs as defined in IFRS 18 in a single note disclosed in the financial statements. So hopefully this helps, and I think that then for the presentation on the face of the P&L, I would say if there were both MPMs and APMs presented on the face of the P&L, I think it would be interesting to, on the face of the P&L directly, to identify which of those are effectively MPMs to which IFRS 18 applies. But then I think it goes probably to the how do you say that in English? Maybe French, maybe more ideal for me. the cross-reference, thank you, that can be dealt with the cross-reference from the P&L to the notes to which a single line item is, whether a subtotal or not, by the way, is further commented in the notes to the financial statement. So hopefully it helps in the answer.
Thank you very much. Nick, do you want to complement or everything said?
Sorry, trouble finding the microphone. A very comprehensive answer. I have nothing to add.
Thank you very much to both of you. So one question that we have also touched upon already, I think, is that if a subtotal is necessary for our useful structured summary, is it possible to keep it in the P&L statement even if it meets the definition of an MPM? So I guess the question assumes that the natural order of the structure of the P&L statement will not be touched, so stay the same, and you will add an additional subtotal as you see it as a useful summary. Would that even be an MPM?
I think Bertrand already answered this. Yeah. Well, I was just going to say, I think Bertrand's answer previously it applies here equally. So if it meets those other parts of the definition, so used in public communications, it hasn't been rebutted about management's view, then yes, it would be a management defined performance measure. The only consequence being then the additional disclosure would be required within the notes, but nothing would change about its presentation in the P&L.
So you can keep it in as a subtotal in the statement of P&L. I think that answers the question quite briefly. So next question, I think one of the last questions that we can allow for the sake of time is, are companies able to continue with presenting exceptional items in a separate column of the face of the income statement subject to the new disclosure requirements?
Nick, do you want to answer this one, please?
Yeah. So I think not to sound like a broken record, but the requirements are the same here as well. So there's no specific prohibitions on using a column, for example. However, the measure would need to fit this structure. So where an adjustment would move something from one category to another, for example, that wouldn't be permitted within the statement of profit or loss. But as long as it continued to meet the structure, whether those are in columns or rows, it doesn't matter. It just needs to meet those requirements.
Thank you very much. If I look at the questions that have been asked, then I sort of get a bit of feeling that the question is rather, is it now what the IFRS 18 proposes as a structure and only that, or is there still some room to maneuver and may give that the entity-specific touch? And you answered that quite well. There's no prohibition. Of course, you have to bear in mind that the structure may not be changed, but it may as well be enhanced, if I may put it like that. Great. With that, I would say to all the participants, thank you very much for your questions. Stay on Slido and vote for your questions, and of course, pose your questions there. We will now move on to the third topic, which is grouping, aggregation, and disaggregation of information. And with that, I may hand over to the colleagues from the IASB.
Thank you, Michael. So let's now move on to the final set of main requirements in IFRS 18, which is around grouping of information or aggregation and disaggregation. So if we move to the next slide, the message from investors was that often information in financial statement isn't quite grouped at the right level to provide the most useful information. So some companies don't provide enough detailed information about important transactions. For example, there are often large balances labeled as other. And in other cases, there is excessive information about unimportant transactions, which can then obscure the information that investors are actually looking for. IFRS 18 responds to these concerns by introducing guidance to help companies judge the level of grouping that is appropriate for their circumstances. Now, this includes guidance on whether information should be presented in the primary financial statements or disclosed in the notes. But it also includes guidance or enhanced requirements for grouping items, including requirements for presenting and disclosing operating expenses, which we will talk about in a minute, and disclosures about items labeled as other. So if we move to the next slide, one of the ways IFRS 18 aims to improve aggregation and disaggregation of information is to define the rules of the primary financial statements and the notes. As we discussed earlier in relation to when additional subtotals are required, IFRS 18 defines the role of the primary financial statements as to provide a structured summary of a company's assets, liabilities, and equity, or income and expenses, or cash flows, which is then useful for three things. First of all, obtaining an understandable overview of those items, but also making comparisons between companies and between periods. And last but not least, identifying items or areas about which investors might wish to seek additional information in the notes on. Now, this concept of a useful structured summary will help companies decide which information to present in the primary financial statement and which information to disclose in the notes. Importantly, it recognizes that not all material items can be presented in the primary financial statements, as it would be too detailed to be understandable. There's just not enough room. So a higher level of aggregation is required to provide a useful structured summary. Now, the role of the notes, on the other hand, is to provide material financial information that is then necessary for investors to better understand the items presented in the primary financial statements. But the notes are also needed to supplement the primary financial statements with other financial information to achieve that objective of financial statements. Importantly, the role of the notes makes clear that if disaggregated information would be material, this information is required to be disclosed in the notes. So if we move on to the next slide, to help companies to judge how to group items to fulfill the roles of the primary financial statements and the notes, IFRS 18 provides general principles for aggregation and disaggregation, as I'd mentioned earlier. A company aggregates items based on shared characteristics and disaggregates items based on characteristics that are not shared. So a single dissimilar characteristic could be enough in some circumstances to require the disaggregation of an amount if the resulting information is material. Now, keeping in mind here that aggregation and disaggregation in financial statements should not obscure material information or reduce the understandability of the information presented or disclosed. IFRS 18 includes examples of characteristics for the statement of profit or loss and the statement of financial position that a company considers when making these judgments. Most of them are already referred to in other IFRS accounting standards, with a few additional characteristics that were identified as being important during the development of IFRS 18. So, for example, one of the characteristics a company would consider when aggregating and disaggregating income or expenses is persistence, including the frequency of the item of income or expenses, or whether it is recurring or non-recurring. But in addition to the guidance on when to aggregate and when to disaggregate, the standard also includes guidance to help companies to describe items presented or disclosed to represent them faithfully, including how to find a more informative label than, for example, other expenses. Now, if items for which information is not material are aggregated, the company shall consider whether the aggregated amount is sufficiently large that investors might actually question whether it includes items for which information would be material. And if that's the case, then the company provides further information about the amount. This could be, for example, an explanation that no items for which information would be material are included in the amount, but also an explanation that the amount comprises several line items for which information would not be material, with an indication of the nature and amount of the largest item. And finally, if we come to slide 35, IFRS 18 requires companies that present one or more operating expense line items by function to disclose the amounts of specified nature expenses included in each line item in the operating category in the statement of profit or loss. The nature expenses required to be disclosed, as you can see here on the slide, are depreciation, amortization, employee benefits, as well as impairment losses on non-financial assets. So those are impairment losses within the scope of IAS 36 and write-down of inventories. The amounts to be disclosed are not required to be amounts recognized as an expense in the reporting period. they are permitted to be costs incurred, for example, employee costs before considering allocated to inventory. However, if the amounts disclosed include amounts that have been recognized as part of the carrying amount of an asset, so if they are not expense amounts, then a company needs to give a qualitative explanation of that fact and identify the assets involved. And we can see an illustration of this on slide 36. This slide illustrates what the disclosure of specified expenses by nature might look like. So in this illustration, the amounts disclosed are those recognized as an expense in the statement of profit or loss for the year, except for depreciation and employee benefits. And in this example, the amount disclosed for depreciation is the charge for the year, applying IAS 16, and the amount disclosed for employee benefits is the cost incurred for employee services, applying IAS 19. And because the entity is not disclosing expense amounts here, it has explained that the disclosed amounts of depreciation and employee benefits include amounts that have been capitalized by including them in the amount of inventory at the end of the reporting period. Bertrand, could I now hand over to you for your thoughts on the requirements for grouping? I think Bertrand is
Yes, he seems to
frozen again.
frozen. Right, so we'll just go on and we'll circle back to Bertrand whenever he is back online. So thank you very much for the presentation. Indeed, I would have a question myself regarding the previous slide that we have just talked about, where you say a qualitative explanation of whether amounts have been capitalized or not is sufficient. There is no quantitative information attached to it, like to what extent employee benefits, for example, have been capitalized within inventory or other assets.
Yes, exactly. So the IASB requires entities to give a qualitative explanation, so kind of indicate to investors, hey, these are not all expense amounts, and identify which amounts are not expense amounts, and then also give an indication of in which assets are these amounts represented. A quantitative explanation would have kind of defeated the purpose of finding the right cost-benefit balance for preparers, because if they could have done that, then they could have might as well just presented or disclosed the expense amounts altogether. So yes, it is only a qualitative explanation that is necessary to be given.
Thank you very much. All right. With that, since Bertrand has not made his way back to our session yet, we will hand it over to our panelists and they share their views. And first up is François. François, you have the floor. And for all the participants, again, the reminder, stay on Slido, vote on your questions, pose your questions. François, over to you.
Thank you very much, Michael. So on aggregation and disaggregation, clearly that was the most important, I would say, topic which attracted the attention of management. The reason is that so in our organization we use a presentation by function, not a presentation by nature, and in the exposure draft there was a requirement for companies presenting operating expenses by function to disclose the entire operating expenses by nature. So that was a kind of a shock in a way. And we started obviously thinking about that, what it would have implied. And we saw the change coming during the redeliberation, the fact that we have now to focus only on a limited list of expenses is obviously very welcome. This said, it doesn't mean it's so simple neither, because obviously today we already have some requirements to disclose employee benefits and depreciation, but we don't have to disclose the split by function. So when I discuss with our IT colleagues here, they clearly say that this is a project, even that. So I would definitively encourage preparers to pay attention to that. I mean, this requirement is a relief, but it's not a free lunch, far from that. So maybe that's my first comment. Then we have also I would say really appreciated the fact that the IASB has opened the presentation by function to a mixed presentation. And that's maybe something I would like the IASB to comment, if possible. That is, the standard gives some example of expenses which would deserve separate presentation as a nature, and typically that's the case for the goodwill impairment. I think the question is that actually impairment of goodwill is an example. Okay, so it doesn't necessarily mean it's exhaustive. Okay, there could be other cases, and here I would be interested to have the IASB view on what could be the guidance in a way for companies when they need to separate some expenses by nature, when the primary presentation is by function. Yeah, I will stop there. I will let the floor obviously for the other panelists, but on this one, I think it's something a bit new. Frankly speaking, it's not a revolution, but close to that. We know that regulators and auditors have been extremely strict in the application of the prohibition of a mixed presentation in the past. So now it comes on the table, and I think that's something deserving a few comments. Thank you.
Thank you very much, François. Bertrand, you're back. Welcome back, and floor is yours.
And hopefully you're hearing me well. It's quite a complex question to answer, this one, I must admit, because we are not providing strict prescriptions in this regard. And so, as I've already said previously, as we, IASB, have previously said in this session, judgment will need to apply. So there won't be just one answer that fits all circumstances. What I can say, or what I can reflect on, and that's a personal comment, is that similarly to the impairment of goodwill, I would say that whatever is monitored at group level and is not participating in the operating performance of business units or operating units, maybe on the face of the P&L at the consolidated level for the statement of financial performance, may be considered as being presented by nature in a mixed presentation of the P&L. But that's a personal reflection in a way, and certainly in the standards there is no strict prescriptions in that. On top of all the principles, of course, or there is nothing on top of the principles Juliana described in her presentation.
Thank you.
Juliana, you want to add probably?
Yeah, just to add a few. So goodwill impairment, that one of the examples that we have, and that kind of evolves around the fact that some entities say this is difficult to allocate the functions, and presenting it separately would provide the most useful structured summary. But generally, I think mixed presentation, and we have in the basis for conclusions some, and also in the B paragraphs of IFRS 18, some points when a mixed presentation might actually provide the most useful information. And it could be also you have two main business activities and conclude that either by function or by nature does not work for me. So a mixed presentation might actually provide the most useful information. And then, of course, what we've just touched on, that sometimes allocation to functions would be arbitrary, and the mixed presentation would be the best thing to do. But also, in this kind of, it's kind of the interaction between useful structured summary and this specific presentation. You could also conclude that there is an item that presented separately just provides the most useful structured summary, and hence you're presenting it separately, even though an allocation would be possible. So is also, again, it depends. It's a very entity specific thing. it is important for entities, I guess, to just look at their current presentation carefully now and assess whether that's still the right presentation, applying these new principles and the mixed presentation now being permitted.
So I'll take it that mixed presentation is still, it's not prohibited, but you have to assess whether it does provide the best or most useful information to your users. Understood. François, are you satisfied with the answer, and can we move on?
Absolutely. Thanks a lot.
Thank you very much. Next, I would like to put in the spotlight Maji with your experience.
Thank you very much. There are two main topics. First, I want to talk about the one I don't really have a question, but I think there is like a guidance or just, some experience that we have for the last few years, is that the aggregation, disaggregation here is needing what we've been talking a lot during this webinar, which means judgment. You need to really look at your judgment and think about trying to find a gold balance between not showing something remaining material then, or by not showing others, which is what we really like to do sometimes. So I really think you need to try to find in your company some sensible rule of trying to aggregate and disaggregate and using the judgment here and not trying to fall on, some kind of a to-do list or, the companies are usually specifying this and that, so I'm just gonna do the same. But really need to think about what needs to be separated and presented separately and what can be still aggregated to the other position or some other label. This is what we found having difficulty with at first, and I as just a test, I actually teach financial reporting right now by IFRSs. So I gave my students this task. I gave them IFRS and I told them, do this P&L by IS1 and do this P&L by IFRS 18, because those are the best group to go to. People who don't really want to do it, who want to do it quickly and go to another thing they want to do in their life. So I wanted to see how they would apply the standard, quickly. And I found out that some of them went to be very specific by IFRS 18. So they really tried, they read do not do others. So they really started, pointing out lines that weren't really material. And that's where we are trying to tell you, keep about thinking about the root being material and keeping the gold balance between disclosing a lot of information but not being too detailed, because then you're losing out on the quality of the financial statement. So that's one of the big remarks that I have here. And the second one is what was touched on. Okay, Bertrand, I guess you want to say something?
Just wanted to benefit from the fact that you're mentioning materiality, because I think for those principles on aggregation and disaggregation, materiality will be absolutely key in the assessment of what to disaggregate and where, whether it's on the face of the P&L or in the notes. And what I wanted to say is that the materiality assessment is on quantitative term, but also on qualitative terms. And when it comes to qualitative terms, it's both from an absolute aspect or a relative aspect. So if an amount may not be considered as material, but all other companies are materially impacted quantitatively, I am not, but by disclosing this information, the information I will be disclosing may be considered as qualitatively material for those users of financial statements receiving and consuming the information. So there may be, maybe not in the P&L, on the face of the P&L, but in the notes, there may be some consideration into providing this information because it would be considered as material for the investors that are those to which for which the information is prepared.
Yeah. So as we were talking about judgment all the time, And the second topic, what already Francois was talking about, is the way that we are working right now within the systems. We have usually I see two approaches. So we usually have either one main cost accounting, which means by nature or by function, and then we do some disaggregation, some additional information or analysis, or for example in Polish jurisdiction usually have both, but we keep separately some of both. And in either of those cases, you have this difficulty that you need to have this disaggregation on matrix, and this is where both systems are lacking the information. And what Francois said, going back to IT system providers, they tell you that it is a project to build up the system that will allow you this matrix that need to be presented by IFRS 18. So do really think about it earlier on, and talk to your IT providers, especially if it is a part of a bigger project, because it's a group system and it has to be united across the board. It will take a lot of time to adjust it accordingly to IFRS 18. But then I have the question which we talked about already regarding the mixed presentation and the disclosure. So I see that we can have this mixed presentation. So let's say mainly by function, and then some lines by nature, and then in the notes we would present this matrix by nature, by function, and have this qualitative information talking about, okay, the material used is partially restrained in the inventories in the balance sheet. So looking back at the Polish financial statement per local gaps, we have this sort of cumulative one number that tells us that overall we had 1 million costs, but 500,000 of them are restrained in the balance sheet. So let's say half of them. I'm just trying to get easy numbers to wrap our minds around it. Which we can see in Polish financial statements that the numbers can be really big. So would you say that adding the information, the quantitative information about, let's say, maybe the rough percentage that's restrained from those numbers within the balance sheet would be an additional information that's nice to see for the users? Or would you think that it may be very enhancing for the quality of financial statements, or the qualitative is enough and we don't really need this piece of information? So whether the firm should consider adding this information if they know they have those big variances year to year going on.
It's a good question. Now, while the IASB, as we just already touched on, is only requiring a qualitative explanation, kind of to alert users to the fact that the amounts disclosed are not expense amounts, IFRS 18 is silent on whether a company could, in addition, give some quantitative assessment, like as you've described, giving some percentages, but also not prohibiting companies to give such voluntary information. I guess that probably depends then on the company and the auditors to find something that they actually want to put in the public, a number that they want to put in public. But there is nothing in IFRS 18 prohibiting an entity from giving more than the bare minimum of the qualitative explanation.
Okay, thank you.
Of course, as we said previously, as long as providing this additional information does not conflict with a requirements in IFRS 18. And it was the example we discussed with Nick on APM and MPM, disaggregating really in the note the information for MPM, isolating it from any and not blurring it or grouping it with information on non-MPMs.
Thank you very much, Marty. Thank you very much, Juliana and Bertrand. Next one with the next questions, we have Lars on the line.
Thanks, Michael. So let me start by echoing Francois' words, who also stated that we welcome the relief that the IASB introduced during the feedback process with respect to the reconciliation between the categorical and the functional P&L. But that we indeed still expect some costs to be incurred to comply with the requirements under IFRS 18. My second point relates very much to what Maciej already indicated, and that relates to the reduction or the limitation on the use of the other category. So we have been talking a lot about the judgment, but to what extent is this limitation on the use of other? Can it be considered a move away from judgment towards a more rule-based regulation?
Thank you, Lars. The floor is yours, Juliana.
Okay. So, I mean, we are conscious of the fact that this line item other might remain in some of the financial statements, but what we think that with our principles of aggregating and disaggregating, and also the requirement to label the items faithfully, is that we can get to a better position than we are now. As I'd mentioned during my presentation, investors have complained and said there are sometimes these very large balances just labeled other with no further explanation. It's not really clear what do they comprise. So we do have application guidance on how to go about a situation where you have maybe aggregated some material items that have dissimilar characteristics, and how you could then go about best labeling them so that it is clear what they comprise. And we have also some specific guidance on when you have maybe a line item that has a quite large balance. You still feel like you have a fairly non-prescriptive label, like, for example, other operating expenses. If that were the case, you would then give a further explanation in the notes just to resolve that question that investors have. Is there anything in that line item that I actually need to know about? And the entity's just not disaggregating and not showing and explaining to me.
The idea of the requirements is really to try to, from a practical standpoint, to minimize the remaining other, because there will be a limit to what we can explain, and there will always be a remaining other or a remainder in the other. And the idea of all those requirements are really to have that as minimal as possible.
Yeah, thank you.
Okay, thank you all. Very interesting. So, Bertrand, now, you have been cut off before you could give your general thoughts on why you think that these new inclusions in the standard do make sense and provide useful information. Should we go to, up to you, should we go to the participants' questions at first, or do you want to maybe highlight, also give your view before we go down into the next route of questions?
Yes, I can do that quickly. And sorry for
No
the unstable connection I encountered this morning, which is quite unfortunate because it's not usual. Firstly, I think the new application guidance on grouping of information should be helpful, and combined with the requirements for categories and subtotals is a real opportunity for companies to reevaluate their current reporting to ensure it is giving them meaning the investors, the most useful information possible, which will of course result in information that those investors are looking for. These requirements strike a balance between requiring specific information and appreciating the cost to companies of providing that information. For example, we have been on quite a journey with the specific disclosure requirements for expenses by nature, considering seriously the need of both preparers and investors to refine the proposal in a way that might achieve a better cost-benefit balance. And it's great to hear the feedback of some panelists that they felt heard on that. Thank you for your kind feedback on this one. And specifically on this one, preparers were concerned about the cost of providing information about all of their expenses by nature. And we heard that this was not how their current systems were set up in or are set up in many cases, if not most. And But at the same time, investors said that they wanted to better understand in which line items in the statement of profit or loss, particular expenses are included. For example, how much depreciation does a particular company include in cost of sales? So as a result of the extensive outreach we undertook at the time, we believe the IASB has now achieved a balanced outcome that will help preparers keep costs at a manageable level and help investors being better understand the composition of line items in the statement of profit or loss.
Thank you very much, Bertrand. And what you just said is it is also an opportunity to reevaluate the way in which companies report to the outside world, so to capital markets, to investors. There's one question from the audience that fits quite perfectly into this. And that question is, when using a profit and loss statement by function for internal and management purposes, would that mean that an external presentation by nature cannot be retained for the financial statements? So the internal reporting by function and the external reporting by nature, given there are now some criteria to aid the assessment on what seems to be most useful.
Again, quite a difficult question. So what we have in IFRS 18 is some criteria to help entities decide how to present line items. And from IAS 1, we've moved away from speaking of one presentation method for an entity. So it's a line-by-line assessment of nature or function line item that it present. And those criteria that we have, one of them being what provides the most useful information about main components or drivers of my profitability, but also what closely represents the way the business is managed internally, or industry practice, for example, also being one of, and then lastly, would allocating something to functions be arbitrary? We've just touched on that already in one of the questions. And we don't really have a hierarchy for these indicators. So generally an entity would have to look at all of these 4 indicators and then come to a conclusion. And that assessment, as I've just mentioned, it's made on a line by line basis. So it's not, I look at the indicators, I decide my presentation method is function. And hence that means all line items have to be function.
Thank you very much. Nick, please.
Yeah, I just wanted to add, because I find the question a little bit curious, because in a lot of our outreach, we hear that what's used internally is generally what is useful to users externally. And so in that respect, the information is aligned. So I think I would just challenge somebody to really think about, is that the best presentation by nature if what they find useful internally is by function? Now, it may be the case, as Juliana says, they're not hard rules that you must do this, but I mean, I would challenge people to really think about these indicators. We didn't kind of come up with them out of thin air. They were a result of a lot of consultation with both users and preparers, and this was one of the messages that usually those information needs are aligned. So think about them, but we want preparers to come up with the best presentation that in their view. So there is judgment there.
Thank you very much, Nick. Bertrand.
Yes, just I wanted to say about the same thing as Nick. Maybe adding a bit more bit broader scope to the question. What we are generally hearing from companies is that they are asking for the IASB to set requirements that are meaningful for them to manage their business and to be used to assess the operating and financial performance of their businesses. And at the same time, we are hearing from investors that it's exactly this entity-specific information that they are interested in receiving. So basically, what we are trying to do is to find a balance of course, to which extent this internal information may be made public or not. That's obviously the case, but there are many considerations where recently we have effectively tried to facilitate the providing of entity-specific information managed by the internal financial reporting of the group, of the company, in the financial statements or in the notes to the financial statements for the external users, and have those more closely aligned. An example is the some proposals that we set in the exposure draft on business combination disclosure and impairment for the impairment test requirements, and when evaluating a DCF model for the assessment of the value in use of a cash generating unit, to get closer to the business plans that are managed internally by the reporting entity, rather than having a pure accounting construct disconnected from the internal reporting. So it's not isolated to IFRS 18. It's something that is often considered because investors are also interested in this information and understanding on how companies are effectively managing their operations and how it translates into their the operating and financial performance.
Thank you very much. There was a very good answer, very concise and surrounding the topic. We have two more questions, which I would ask you to answer very briefly, since we did not make up much time, I'll say, which is my fault. First question is, and really try to be brief, do you expect that a lot of IFRS reporters will revisit the way in which they report? How much of an impact do you expect? IFRS 18
we don't know to answer. I wouldn't know how to answer this question. I'm not sure my team would be able to say that, but I let them answer if they can. But what we can say is it's a new IFRS accounting standards, and we expect company to revisit the structure of their external financial reporting with the enhancements we have put forward in IFRS 18. So maybe there will be no impact at the end, but for sure during the transition phase to IFRS 18, we expect companies to reconsider what they are currently doing and to see where they can enhance what they are currently doing.
Thank you very much. Nick?
Yeah, I think this is a big, it depends where your starting point is. If those that are closer to what has been proposed will have much less change, those that are further away may have significant change, and so it really depends. But I hope listeners today got a sense of there are a lot of things to think about. I mean, we talked about the categories, some of the details, foreign exchange, for example, we didn't talk about, but there are requirements for things like for hedge accounting, for derivatives, et cetera. So there's lots of things to pick apart and to think about, and again with disaggregation, which we just have. So I think we expect that there will be some change for everyone, and the extent of it will be larger or smaller depending on where you are starting from in relation to what's being proposed.
Thank you very much, Nick. Last question on this topic, interim financial reporting. Would it be mandatory to make that disclosures in the notes also for the interim reporting or only for the annual reports? Something.
It's quick response. So no, there are no requirements to also give this information in interim financial statements. Basically, two reasons. One, the cost may be just too high to put that information in, although users would have been keen. But also thinking of consolidated financial statements in condensed financial statements in interim reports, and what this note is actually doing is tying back to the P&L. It might have been a bit difficult to put in such a requirement. So no requirements for the interim period.
Thank you very much. With that, I will hand over back to you, and we enter the fourth and last topic of today, which is limited changes to the cash flow statement, effective date, and transition requirements. And with that, floor is yours.
Thank you. As I've whizzed past the cover page, there is a title here that suggests there are only limited changes to the statement of cash flow. And so IFRS 18 is introducing 2 changes there. We know in current practice today that entities use different starting points for the indirect method for reporting operating cash flows. And investors have indicated that diversity in practice reduces comparability between entities, and that makes an analysis difficult. In addition, the accounting policy choices that we have today under IFRS 7 for classifying the interest and dividend cash flows equally cause diversity in classifications. And again, as we had in the P&L, that's even between companies in the same industry. So that diversity, again, reduces comparability and doesn't necessarily convey the information about the role of interest and dividend cash flows in the company's business. So to reduce that diversity, the subtotal of operating profit will be required to be the starting point for that reconciliation. And to reduce the alternatives currently permitted around the interest and dividends, the classification we can see on the slide will be required to be investing activities for those interest and dividends received and financing activities for those that are interest dividends paid. Then those we won't talk too much about, but know for if you're in the category with specified main business activities, those are adapted slightly to go into an individual category for each of those items, and that's to allow it to correspond to those choices or those policy choices we talked about if you have main business activities where you move income and expenses into the operating category. So then on the effective date, as a reminder, as Bertrand already mentioned, the standard will be effective for periods on or after the 1st of January 2027. Early application will be permitted, and the standard will be applied retrospectively. Important to note that in the first year of adoption, a reconciliation will be required from the current presentation under IAS 1 to the presentation under IFRS 18, and that will apply in both interim and annual statements. And hopefully we've made up some time. Turn it back to you to see if there are questions.
Thank you very much. We did make up 2 minutes, so well, good to go. We'll have enough material for the last 17 minutes, but I will not waste more time, but I'll hand over to Andreas Gattung, who will have his experience, his feedback on the cash flow statement and the transition requirements. Andreas.
Yeah, I hope I not use much time here. Very important, I think Eva, Francois already pointed out, we have a standard applicable in 2027, but we are in 2024. Do we have a lot of time? No, because we need to apply it retrospectively. So the readiness of the data system must be in 2026 already, so we can collect the data on group level. And if I want to collect data on group level in 2026, our subsidiaries need time to change their subsystems before. And therefore at Volkswagen, we are currently working with full pace, especially to find out where we have to change our data model. Other things like MPMs may be cancelled later because it's more about reporting, but everywhere you change your data model, you have to be very fast at the moment to have your subsidiaries a chance to adapt their systems. Very important in this point is certainly the cash flow statement. Yes, there are no only minor changes, but especially the fact that we move from income after tax to operating income in the operating section means that we have a lot of changes now, or minor changes in the cash flow statement for the investing in the financing. And cash flow statement is not only fed by P&L. Everybody looks at the moment it's a P&L, but the cash flow statements, this is fed by the balance sheet. And to provide this data, you may also have to look into your balance sheet. If you have the information separated, you need now, for example, to bring things out, your working capital, you have it today, and have it in a direct presentation in the investing and financing section. This can be challenging too. That was my comments.
Thank you very much, Andreas. So we have one more question from the audience before we move over to our takeaways. But first, to Andreas' comment, your colleagues from the IASB, do you want to comment on what Andreas has said? No, so we can confirm there's not much time left. There's still a lot to do. Right. So then there is one question from the audience as mentioned, and that is why, what is the reasoning for using the operating profit as a starting point for the cash flow? What's the main reason for it?
I think and Nick can certainly add or amend nuance what I'm about to say. But as now IFRS 18 is defining operating profit as a required subtotal, so as a universal required subtotal, I think investors had the request to better understand the non-cash items within the operating profit, within this operating profit, to enable them to have a better starting points for their analysis of the cash flow impacts. That's really the way I understood this change.
Yeah, I would only add to highlight those were all true for why operating profit specifically, but the challenge was to get more comparability in that starting point in general, and so that was the reasons why operating profit. But to remember, the reason to have a specific subtotal was to get comparability.
Thank you very much. With that was the last question. Let me say thank you to you all for your valuable input and contribution. And we'll have one more for you. Sorry, that just comes in last minute. Regarding the other category, is it required to make disclosures in year-end financial statements under IAS 8/30/31? Possible impact that implication of the new IFRS regarding IFRS 18. Year-end. So is that for the new standards and what the impact will be? Don't know whether there are any specific disclosure requirements within IFRS 8 for the transition period. 18.
Rowan, you can maybe correct me if I'm wrong, but with that particular requirement, there's no specific exceptions. It would be required to disclose the expected impacts in the future as with any other standard.
All right.
What we have required in IFRS 18 is to have this presentation applied retrospectively. So the first time application date is the first reporting year. So if a company applies it in 2027, so publish its first financial statements using IFRS 18 in 2027, in a European context, in most circumstances, the first time application date will be 1st January 2026. And there is a requirement to retrospectively apply IFRS 18 and to provide for 2026 a reconciliation on a line-by-line basis of the P&L that was previously presented in IAS 1 and that is recasted applying the new requirements of IFRS 18 to be in a position to enable investors to be in a position to receive an information that will enable them to reperform their projections, their models, with a sufficient trending or a sufficient trend in the information provided, and they so that they can reconcile from what they were previously receiving and what they will be receiving with the new information.
And just to add to that, so as Nick mentioned, the only requirement in IAS 8 that is changed in that transition guidance is the requirement that Bertrand just mentioned. IAS 8 paragraph 28F would require that reconciliation for all reporting periods presented, but we have given specific relief or put the requirement into IFRS 18 and said that you just do it for the most recent comparative period. So if you're giving 2 years of comparatives, you would only do it, in Bertrand's example, would be for the 2026 year. If you're giving 2025, you would not be required to do it for that, and you would also not be required to do it for the 2027 year. But the requirement prior, so for example, in your next financial statements where you have a standard that is issued but not yet effective, and you're required to give some disclosures around that requirement, we have not made any changes to that, so you're required to give those disclosures in accordance with IAS 8.
Thank you very much. With that, we will close all the question session. Again, I repeat my sincerest thanks to you all for the contributions, dear valued panelists, dear colleagues from the IASB, and of course the EFRAG team who has been working hardly in the background. Big thanks to you. We'll round off this education session with some takeaways where Katrin will join me. I will start and then Katrin will chip in. So what we have seen today is a lot of deep insight, even though we have probably touched only on the surface. We have learned that despite that the fact that IFRS 18 will bring more comparability to the statement of profit and loss, there is still room to maneuver and judgment to be applied, which is necessary and does not deter usefulness in that sense. Just for some examples to be given, we have judgment when it comes to the application of the allocation of FX effects, which is done on a line-by-line basis and not a once and for all ticket on that instance. We have seen that the same applies also to I'm staying with the conglomerates now. We've seen that the level of assessment when you are a conglomerate and have main business activities still highly depends on the way your company is structured. We have seen discussions around equity investments which are not part of the operating profit, but maybe just below the line item operating profit, so can be displayed clearly also without MPMs in that sense, which may be somewhat different than companies look and steer their business, which would also be true for cash or the income from cash and cash equivalents, which some companies may view differently. Then it will be presented in the statement of profit and loss, which is basically due to the fact that investors have specifically asked for that information to be structured as it is. We have also talked about MPMs, which is a sort of a smaller section than the APM guidelines that we use, where the aim is clearly to provide more transparency and also reliability through a mandatory audit, since those information will now be part of the financial statements and thus audited. And we have also seen that there is some flexibility to adjust to other non-MPM APMs. Now, using too much letters here, so we can companies are in the position to make most of that single note that you're presenting, also the reconciliations, despite that we have also heard that there may be challenges also when it comes, for example, to the definition or derivation of the tax effects when it comes to providing those disclosures. Also, we had some discussions on the subtotals, where we basically can summarize that as long as you don't structure or don't touch the structure of the P&L, which is sort of carved in stone, then you can add subtotals, of course, and derive your MPMs from there. So there's also some room to maneuver. When it comes to the aggregation and disaggregation, then we've seen a journey, which we have seen all over the standard, from the initial exposure draft to now the final standard, where panelists have echoed that we see a much more balanced view of the new requirements to present the primary financial statements, especially the statement of profit and loss, which is materialized, for example, by the reduction in the amounts and items to be presented by nature when the statement of profit and loss is structured by function. Also, there is some room to maneuver and judgment to be applied when thinking about adding more than the specified items in the standard to that. Also, we have learned that mixed presentation is still an option, and that, which was one of my key takeaways actually, that the decision on whether we present by nature or by function is effectively a line-by-line decision and depends on how the company steers its business. And materiality, of course, is a major criteria when looking at the aggregation or disaggregation. Last but not least, we have heard in the last topic that there's no time to lose. We've heard it from Eva also in the beginning that better start now, better start this year, going from the financing and the investing category and put basically then having the operating category as a result. So there's, as I said, there is a lot of judgment still to be applied. It's not a set in stone, this is what you have to do, and then just do it. But there is a lot of entity-specific information that will be a part of the new disclosure regime, disclosure and presentation regime. So with that, I will now look towards Katrin Schöne, and she has been taking notes also. So Katrin, do you want to add any takeaways? I'm sure you will. Please go ahead.
Thank you very much, Michael. That was very comprehensive. It was challenging to be a moderator and to summarize all this. So thank you very much. Very comprehensive. I would like to take your last point. IFRS 18 has really impact on each and every company. And to get started sooner than later, that's something addressed from several of the participants today. And maybe one supporting message from EFRAG on this. During the EFRAG board meeting, we did not identify any blocking factors for the endorsement so far, and I do not see any feedback today that would give such point of attention to us. So we are on a good way for the endorsement. We try to be in time that it is even possible to early apply IFRS 18 in Europe. And I would like to say thank you to all the participants. Thank you to the audience for raising the questions and making the meeting today very interesting for us. We will analyze these questions afterwards, whether there's anything which we should consider and address in the endorsement advice. It's very helpful that we have these questions. And I would like to thank the team here in the room that they prepared this event, and all the participants for all their valuable input, and thank you to the IASB for presenting to us today.
Thank you very much. With that, we will close today's sessions on time. We made it, so you made up enough time in the end. Thank you again very much. We wish you a pleasant weekend when it finally arrives and a bit of sunshine. And we're looking forward to engage into the discussions in the future with you. Thank you very much.
Thank you very much to all. Thank you.
Thank you.
Thank you very much.
Thank you.